everyone. We will give people about another 30 seconds or so to join this session and to take note of the disclaimer that we will be putting up on the screen, and then we'll kick things off. Welcome to Mawer's 2023 Insight Webcast. My name is Janelle Hart, and I'm a private client investment counselor here at Mawer. We appreciate you joining us today for our panel discussion about the state of the markets and to ask your questions of our portfolio managers. Thank you to those of you who submitted questions in advance. And for those who still have questions throughout this session, you can go to slido.com, SLIDO.com, using the event code MAWER. That's capital MAWER to enter your questions as we go. Before we begin, I would like to show my respect and to acknowledge that for those of us in Calgary, we live and work within the traditional territories of the Indigenous peoples of the Blackfoot Confederacy, Siksika, Kainai, Piikani, the Tsuut'ina, the Ai'ai'he Stoney Nakoda Nations, the Métis Nation Region 3, and all people who make their homes in the Treaty 7 region of southern Alberta. I thank them for their continued stewardship and for sharing this land. And Mawer is committed to elevate Indigenous voices and to collaborate to advance reconciliation. Now I would like to introduce our panelists, who are all portfolio managers within our research team. Today we have with us Paul Mraz, Christian Deckert, Krista Coughlin, and Jeff Moe. To start, Paul is going to give a brief update about Mawer's research team, and then Christian is going to take us through a short presentation. Following that, we will get into your questions. So let's start with you, Paul.
Thanks, Janelle, and welcome everyone who's tuning in. And, you know, the quick update, and this is all public information, I'm transitioning the Chief Investment Officer role, and I have the pleasure of transitioning that role to Christian. So this is passing of the torch. And Christian and I, gosh, how many years has it been? Close to a decade, Christian? Where we've worked together. And what's really important about our firm is philosophy and process, and Christian will be a guardian of that. And we felt that it was a great opportunity to talk a little bit more about that. So Christian, why not take it away, re-dip our clients in philosophy and process.
Excellent. Yeah, thanks, Paul. Thanks, Janelle. So yeah, we've prepared a little slide deck for you. Most important thing is to think that long-term performance, as you will see it in our strategies, in our opinion, is driven by the people, the investment philosophy, and the investment process. So you can think of it, the 3P, people, philosophy, process. And today we want to give you some insight into those ingredients. So people and our culture, I think you'll see it on screen for the next 60 minutes or so as we interact, as we share our thoughts. And then if after this call you still want to dive deeper, I think on mawer.com we have a link to our Art of Boring blog and podcast, which contains regularly updated views and opinions of a portfolio manager, different people at Mawer. So I think that's also a great more permanent tool than to get insight into our thinking, into our culture and who we are. So with people out of the way, I want to talk about the other two P's. And the first one you see here on this slide is the philosophy. And it's simple. We are long-term business owners. Today we should honor Charlie Munger, who passed away yesterday, who's been very influential to many people in the investment world, and I think many people at Mawer. And he had this saying that is quoted everywhere today now because it's topical. The big money is not in the buying or selling, it's in the waiting. So in our language, it's in the holding of the businesses. So that's really what we do. We try to pass on economics of good businesses to you, to our clients. Now, what's the criteria of our philosophy? We aim to find companies that are wealth creating, are run by excellent management teams, and then we aim to get them at a discount to intrinsic value. Now, let me give you a bit more flavor around that and why that matters. Wealth creating companies are ones where we see a high return on capital above the cost of capital. Only then real wealth is created for shareholders. And to be clear, well, through our strategies, you are the shareholders. We need a competitive advantage for that, and we need to analyze what that competitive advantage is. If we found a good or maybe even great business, but then we had a bad management team on top that wastes shareholders' money, that doesn't allocate capital in a reasonable fashion or pays themselves too high salary, well, that wouldn't help our clients. So we need excellent management teams that are aligned and that do look out for good capital allocation in the best interest of shareholders. And finally, well, if we found a great business and even if we found a great management team with it, if we as your asset managers overpaid for that asset, well, it still wouldn't help the unit holder. It wouldn't help you, our investors. So we need to be careful about the price we pay. So that in a nutshell is our, says it in the bottom of the slide, our common sense investment philosophy. And to give a bit more flavor on that yet, and the word flavor is important here, look at the middle picture here on the bottom of the page. That is a cup of coffee. It stands for a company we own in the global equity strategy, in the EFI large cap strategy. It stands for JDE Peet's, the world's second largest coffee producer, a company that we think is a typical wealth creating business run by excellent management teams, and that we were able to get at a reasonable price. Classical be boring, make money business. The soundbite I read recently is every second more than 4,000 cups of JDE Peet's drinks are sold. So whenever you have your next coffee, keep in mind maybe to support the global equity and EFI large cap strategy by choosing a JDE Peet's coffee or tea. They have a small tea business. Now you might say, Christian, I understand that philosophy, but these are all assessments. These are judgments. How do you get to the point that it's wealth creating, management is excellent, and there's a discount? And that brings us to the investment process. And my colleague Jeff is going to take you through the process.
Thank you, Christian. So when we come across a promising idea that we think may fit our philosophy, we take it through what we call, as you see on the slide, our intensive analysis process. And the point here is it's both analysis, meaning we use our left brain and try to check our emotions at the door as much as possible, as well as intensive. We try to turn over every stone that we can to get to our investment conclusion. So like other investors, we start by reading the materials published by the company publicly, and we try to analyze that and try to understand whether or not the company could be wealth creating, what its competitive advantages are, could the management team be excellent, and could it be trading at discount to intrinsic value. But then we go much deeper than that. First, when we go deeper, we talk to management. So usually we are able to talk to the CEO because of our large investment asset base and our long-term holding, which companies typically like. And so across the team, in any given year, we speak with more than 1,000 management teams every year. And this really allows us to assess the strength of the management team, as well as better understand the company's business strengths and business strategy. But second, we don't just stay at management, because sometimes managers are very optimistic about the businesses they run and may be biased. So for this, we collect scuttlebutt, talking to customers, suppliers, competitors, even former employees, all the types of people who are probably less likely to present a rosy picture of the company that we are trying to analyze. So the other piece is risk, and we focus a lot on risk as well. So one piece of that is we perform a forensic accounting exercise on the financial statements to try and detect irregularities, whether that's looking for potential fraud or just aggressive accounting. We also examine a company's environmental, social, and governance risks to look for different types of exposures that our investors may face in addition to traditional business risks. So then we take all of this qualitative understanding that we have about the business and we build a discounted cash flow model. Then we use a Monte Carlo method to simulate important variables like the growth rate of revenues or what the profit margin of a company will be over a longer period of time to generate a statistical range of fair value on the share price. We think that more accurately reflects the real world probabilities of investing. Because ultimately what we are trying to do is put the odds in our favor, in our client's favor. And so finally, we take all this learning and we put it together in a report to share it with the team and to also record our investment thoughts for that moment in time. But this is iterative. This is not a one and done. So the final piece of our intensive analysis process is actually a circle right back to number one, which is for every company our clients own, at least once a year, we'll do all of these 6 steps again, because we want to make sure that over time, the company still fits our rigorous investment criteria. So we think that we have a robust investment philosophy that helps us analyze the right types of companies, the companies that, as Munger put it, will create lots of wealth from holding. But also, we have a very disciplined and rigorous process to minimize mistakes and to try to put the odds in our clients' favor. So Christian, back to you.
So where we're now is that we have our philosophy. Jeff has described the process, how we then analyze whether we believe companies fit our process. The question is now, well, with your large team at Mawer, you have lots of choice. We obviously have lots of choice which companies then to put in the portfolios. And so the question is, well, how do we do that? How do we choose the companies that ultimately, of all the companies we've analyzed on which we have reports, which go in the portfolio and maybe even at which weight? And so on the next slide, you'll see what we call the matrix. So what is the matrix? Well, it's a place where we would put stock names on it. And every stock will have its unique place. Every company will have its unique place on this matrix through the combination of where it is on the vertical axis and where it is on the horizontal axis. So on the vertical axis, what goes into our assessment is the quality of business model, the quality of management, and the quality of risks. And the better the management, the better the business model, and the lower the risks, the higher we would plot something on the matrix. So on the numerical scale, you see on the right, the more towards a 5. And the return potential axis is the question, well, how much return do we think we get from that investment, or how much do we need to pay for it? And here, the most attractive price would be on the right. So if we pause here for a second and think about that, wait, highest quality companies on the top and best price on the right. Hey, why wouldn't we just buy the best companies at the best price? And if you take that back to an everyday example, say you want to buy a car, and let's just, for sake of argument, because I'm from Germany, let's assume that Porsche is the highest quality car in the world. So a brand new Porsche, and someone told you, hey, you can buy the best quality car in the world, a brand new Porsche, right up here on the return potential axis for the price of a 30-year-old Kia with hail damage. So if I told you that, you would say probably, Christian, there must be something wrong with your brand new Porsche. And we think the same is true with stocks. It is very difficult in a competitive marketplace to get the best quality companies for the best price. So our view of investing here is that we always need to find a trade-off, a balance between the quality we can get and the price we pay. And you will see on this chart on the matrix that the higher or the less of a trade-off there is, the better the combination of quality and price, the higher we'd make the suggested security weight in the portfolio. You see that on the right-hand side of the scale. So the less of a compromise, the higher the weight. And then, well, once there's too much of a compromise, the stock would be in the white, and that would be what we casually refer to as the kill zone. Well, if it's there, we don't think it deserves a place in our clients' portfolios. It's too much of a compromise. Now, this is a tool. This is not a religion, obviously. It's a way of thinking about how things should be weighted. There's other factors like risk management, regional exposures, and so on that play into the actual weights, but I think it's an important way of thinking with which we start our thoughts on portfolio weights. And then a bit as Jeff said earlier, when he talked about the deep analysis of the companies here as well. This is a repeated process. It is not enough to put a stock on the matrix once, because the world changes. Stock prices move. The growth outlook, the profitability outlook for a company changes. So things might move on the return potential axis, actually moves every day as stock prices change. And also on the quality axis, things move. We might learn new things in a management interview when we collect scuttlebutt, as Jeff said. So, we may have owned a business for 2 or 3 years, and then we learn something new by reading the annual report or talking to a customer competitor. So these things move and require adjustments. As I said, it's one tool, it's not our only tool, but I think to understand the way we think about businesses and stocks and what we put in clients' portfolios, I think this is an important tool and first principle to know. This brings me sort of the end of the intro comments on people. You can continue to make your observations on the people, on philosophy and process, and I think that sets the stage for well, I hope you have some interesting questions, Janelle.
We do. Thank you, Paul, Christian, and Jeff, for that update and overview. I think it is important to reiterate our investment process and the depths that we go through in evaluating businesses for our portfolio. So one of the most talked about topics of the past 2 years have been interest rates, the speculation about the movement of which has contributed to a lot of market volatility. We have Krista on the panel today who manages our fixed income strategies, and I thought I'd start by asking her for some insight into where we're at in this rate hiking cycle and what are markets pricing in terms of potential rate cuts next year.
Yeah, thanks, Janelle. So we're definitely closer to the end of the tightening cycle versus the beginning. In terms of market pricing, the market believes the hiking cycle has ended. In both Canada and the US, we're pricing in around 150 basis points or 6 rate cuts starting in the middle of 2024. Now, that's what the market is pricing in. We're mindful that all hinges on the idea that inflation continues to move back towards central bank targets. There's been a lot of improvement in inflation this year. I think we were around 6 or 7% last year. We're currently closer to 3.5. So there has been a pretty material improvement in inflation, but I would say we're still at levels that are somewhat uncomfortable for central banks. And so if we don't continue to see that improvement, those rate cuts could very easily get pushed out further.
Okay, thanks. And another trend we've kind of seen is bonds actually moving in tandem with equities quite a bit over the last 2 years. Which is a bit unusual. And I wonder if rates do start to decline, if we could see that trend continue.
Yeah, I think, the correlation between bonds and equities has broken down over the last 2 years. It's really a function of that inflation backdrop. Sort of that correlation typically breaks down when you are in an elevated inflationary environment. But as I pointed out, inflation is improving. If it continues to improve, it allows central banks to take rates back down to more normal levels, and we should see that correlation come back. So yeah, if we do start seeing rates decline, I think that correlation comes back.
Okay, thanks. And so what does all of this mean for a balanced strategy? Krista, you're part of our asset mix team who makes decisions around how much to have in bonds versus equities and so on in the funds. And what do you think about the traditional kind of 60-40 portfolio?
I think a lot of people have asked if 60-40 is dead, and I don't think that concept is necessarily dead. I think you want to diversify within your portfolio. You want to tilt the weights so that you have sort of the best risk reward at any given time. And obviously, if you continue to be concerned about inflation and correlation, you want to overweight cash in your portfolio. But as growth concerns pick up and if we start increasing the probability of a recession, you want to kind of shift back towards bonds. So no, the 60-40 is still alive. You just want to kind of be active within that.
Okay, and you mentioned recession, so another hot topic in the media. What is, it's generally defined as the fall in real GDP or gross domestic product in 2 successive quarters. So do you see this as a continued risk given the recent data around consumer and business spending? And can you also just clarify for us the terms hard landing and soft landing and what those scenarios would look like?
Yeah, sure. So I think a growth slowdown is almost inevitable. We have had one of the most aggressive tightening cycles in decades. The last rate hike in Canada was 5 months ago. And so that tightening is really still working its way through the economy. And so I think a slowdown from a high level in economic growth is expected. And I think the real question, which you sort of alluded to here, was how big of a slowdown are we going to get? And that's the sort of hard landing versus soft landing concept that comes into play. I think when people talk about a soft landing, they're really just talking about flat growth or stagnant growth, maybe even a very shallow recession. I think we're seeing signs of that. Manufacturing has been slow all year. Business spending has been slow. We are seeing some pockets of weakness in the employment markets. Inflation has been improving. So that soft landing is sort of has been playing out. I think the question is whether or not we're able to sort of stick that landing, I guess, or is that just a path towards a more traditional recession or hard landing? And I think we've talked about this before, but for us, it really comes down to it comes back to that inflation backdrop. And so, if inflation, if central banks are able to take interest rates back to a more normal level, because inflation has moved down, and they're able to sort of take rates lower before we see a larger deterioration in growth, then a soft landing is very likely. However, if inflation remains elevated and the longer inflation remains elevated, pushing out any easing cycle, I think the probability of that hard landing or larger recession starts increasing.
Thanks, Krista. On the topic of business spending, maybe we'll switch to the equity side here. Jeff, could you talk a bit about how the businesses that you invest in have fared from an earnings perspective, just in the face of these higher interest rates and higher inflation? I've often read about how there is a lag in seeing the impact of higher interest rates on businesses and wonder if we're starting to see that work its way through now.
Yeah, that's a good point, Janelle. I think there does seem to be a bit of a lag in the rate hike cycle. I think just this morning I saw that US Q3 GDP was revised upward to be a 5.2% annualized growth. So that's hardly a recession right now. That being said, for the companies that we follow, especially that I follow in both Canada and the US, we are seeing some softness in earnings. I would say companies that are perhaps more focused on consumer spending, or even certain pockets of business-to-business spending is seeing a slowdown. But the slowdown is very gradual. And overall, in the most recent quarter, which would be the third quarter, we still saw quite a bit of earnings growth across a plurality, if not a majority, of the portfolio companies we own. A good example would be a company like FleetCor, which is held in our US Midcap strategy, our US All Cap strategy, as well as our global equity strategy. And so it's a company that processes payments for corporate transactions and also for fleet fuel cards, kind of a bellwether when you think about it, payment transactions across the overall economy. And they actually reported 10% organic growth in the last quarter, which was flat from the second quarter. So still pretty robust growth in that scenario.
Thanks, Jeff. And maybe specifically in that US mid-cap space, could you talk about why we've segmented this space from kind of the all-cap portfolio and give a few examples of businesses that fall into this category that you're excited about?
Sure, Janelle, always happy to talk about that. So I would say at Mawer, we've always had a strong heritage of delivering strong client results in what I call capitalization constrained asset classes, like the New Canada Fund that I help manage, or the Global Small Cap Fund that Christian helps manage. I'd say we began to think more seriously for our clients about segmenting the US, as we noticed that from a lot of clients, while the desire for US exposure was still strong, there seemed to be increasing focus towards investing in the US passively, and specifically by buying an S&P 500 tracking index fund. And there's nothing wrong with that. We think the S&P 500 is a very strong index. It's the 500 biggest companies in the most dynamic economy in the world, the US. But in recent years, as people probably know, it's gotten increasingly, I'd say, concentrated in the top 5 or top 10 companies. At most points in time in the last few years, the top 5 companies have all been technology or technology-related companies. So not only do you have a large concentration of almost 30% in the top 5 companies, but all 5 of them were in the same type of industry. And so when we looked at the market segmentation in the US, we noticed that mid-cap stocks were defined by the index to be as small as about 500 million of market capitalization and as high as about 60 billion of market capitalization. And in our past experience investing in these companies in the US through our US equity fund or our global equity fund or global small cap fund, we felt there were many good companies that were large enough to have already an established competitive advantage, but they weren't so large that they had started to saturate their market and the growth rates were starting to slow. And so in the time we've had the US mid-cap fund, I think we've come across many successful companies in that cap size range. So one might be FTI Consulting, which is the US's largest bankruptcy consultant. And it's actually almost doubled since we first included it. So it's gone from about a 4 billion market cap to close to an 8 billion market cap. TradeWeb would be another example of a company we found. They are the leading electronics bond trading platform in the US. And their market cap has gone from about 15 billion to 25 billion in this time. And then on the upper end would be a company like O'Reilly, which is one of the 2 largest aftermarket auto parts retailers in the US. And they've gone from about a 30 billion market cap company when we first started looking at it to today it's 57 billion. So just across the entire cap spectrum, there's kind of 3 examples of companies we were excited about, have already done well with, clients who have been in a US mid-cap fund have done well with, and we were excited about their prospects over the next 5 to 10 years.
Thanks, Jeff. And you did mention there the tech concentration in the US index, and we certainly saw a big rally over the summer in businesses benefiting from the excitement around artificial intelligence or AI. Maybe I'll pass this one over to Christian to just talk about what kind of exposure we have to that AI trend and ask you, what do you think about the risks and opportunities in this area from an investment standpoint?
Yeah, I mean, one of the fundamentals at Mawer is we always say, prepare, don't predict. We don't know the future. We can only do all the work that Jeff mentioned before to narrow down the probabilities. So themes like AI or Bitcoin in the past or wheat stocks in the past, these are always two-edged swords because they're also so risky. So no theme like AI will change our investment philosophy. We need wealth creating businesses, excellent management teams, and then reasonable price. And not because they are AI, but we ended up with 3 companies in the portfolio that now appear to be pretty decently placed in the AI race, if you will. So the global equity portfolio is a shareholder in Microsoft, in Amazon, in Alphabet, Google. So these are 3 companies that are very active in the AI, in the AI market. But I would say our investment case, the reason why we bought them, didn't rest on AI. So I hope it's going to be a success, but we haven't. I don't think we've bet the farm on it.
Thanks, Christian. So I heard you often, kind of talk about how market volatility can create opportunity, and how, we're very patient investors in terms of the price we're willing to pay for a business. Christian, could you share maybe a story about a company you've added to one of your strategies over the last year or 2 that perhaps you followed them for a really long time and they kind of fit the quality spectrum, but market volatility created an initiation opportunity?
Yeah, I think I have a very good example actually from a bit longer, Janelle, but if you remember H1, first half year 2020, when COVID hit, there's a company in the US called CDW, which also today held by I think our US strategy and the US Midcap strategy. CDW, what do? Well, a medium-sized business may need some help on their computer software that they use on procuring their hardware. So companies like CDW, they distribute software and hardware, but they also do sort of consulting, independent advice, producer independent advice on how exactly companies should put that together. CDW is a company I think I'd heard of for the first time 15 years earlier. And we had followed it from a distance at Mawer for quite a long period. And then if you think of what happened during the beginning, COVID shutdown, first half 2020, well, it moved in two directions on the matrix. First of all, stock prices came down, so CDW all of a sudden moved to the right, if you will, on the matrix. It became attractive. And then secondly, as we looked around the world, there was also volatility in the fundamentals of the business, in the operations, because all of a sudden, and that's positive volatility, all of a sudden to us at the time, it seemed more likely that companies will spend more on IT. Well, why? Well, because all of a sudden the workforce was disparate around different places and remote working. So we thought that the odds of a continued good business environment weren't bad in that case. In addition to all the other criteria, right, that we need to come to that point in the conversation, we thought it was wealth creating, excellent management team, and then H1 2020 happened. So that is a benefit of volatility on both sides, on the fundamental side and on the valuation side. And we haven't seen much of that volatility, I would say, over the last 15 years because of what central banks have done, in my opinion, by buffering or cushioning a lot of the volatility we probably would have seen normally. So as a fundamental investor, I'm actually quite excited if central banks take a step back from cushioning everything that happens in markets.
Thanks, Christian. Jeff, do you have any examples from maybe the Canadian small cap or US mid cap strategies that you could share just in terms of how the volatility over the last couple of years have created opportunity in your space?
Sure, yeah, Janelle, I think I could come up with a couple. Hopefully slightly more recent than Christian's example as well, to show that we continue to take advantage of market dips along the way, not just the very, very large market dips. So if we look at the current stock market cycle, the recent bottom would have been in the fourth quarter of last year. And that was when rate hikes were kind of at its peak in terms of consciousness to the investment community. And so a company called Donnelly Financial, which is a software and services provider for companies that need to file their regulatory financial filings, so things like the annual report, the quarterly reports. So this is a company that makes quite a bit more money when a company initially files their publications. So when a company essentially does their initial public offering or IPO. And in 2022, as you probably recall, IPOs really slowed down because the stock market was dropping and many companies that were considering doing an initial public offering pulled back. And so Donnelly Financial suffered and its stock came down quite a bit. But when we analyzed it, we put it on our 15-year discounted cash flow model, we felt that there was actually a very, very high probability that this company was now trading at a discount to intrinsic value. Not to mention that it's a wealth creating company, it has a strong competitive advantage. And so both our US mid-cap strategy and our global small cap strategy established a position. And that has been one of our best performing companies in the last year. And maybe very recently, again, in the US mid-cap side, would be Ulta Beauty, which is the US's largest cosmetic and beauty retailer. And so they recently hit the lowest price they've seen in about 2 years, mainly on this back of this idea of a consumer recession, which it's true, it's coming through in the data, and there is a bit of a consumer pullback. But again, sometimes markets can overreact on these kind of short-term concerns. And so when we did our discounted cash flow analysis, again, we felt that this company was trading at the lower end of its fair value range. And it's a very highly wealth creating company when you look at a return on invested capital, which is a very common metric to use to assess wealth creation. This company historically has been in the 25 to 30% range. So it's a very, very high returns, and we were able to pay a very reasonable price for that business.
Thanks, Jeff. And I can vouch personally for their face sunscreen. Okay, so Yeah. Switching gears here, Paul, could you talk about how we incorporate global geopolitical events and unrest into our investment analysis and decision making? Obviously, there's a lot of devastating turmoil in the world right now, and clients have asked how this could impact their portfolio.
100%. There always will be something in the world. There always has been something in the world that is concerning. And, you know, I'm going to tee up, and maybe Christian can add, because he did an excellent podcast on non-predictive decision making. And this is where I want to go to it. Each of us, as we build the portfolios, an outcome of what we want is to make it resilient. So whatever geopolitical, economic situation you get in, that portfolio is able to bounce back from that scenario, from an adverse scenario. And that includes geopolitics. And that means really not having too many sharp edges in the portfolio, and recognizing that if a scenario happens, have you properly discounted that event? And that could show up in our models. It could show up in the discount rate we use. It could show up in the Monte Carlo analysis and maybe the distributions around growth. All that bottom-up work that we do, but we want that resilience. And so what's important to understand, Christian, I'm passing it to you on this, on non-predictive decision making, is we're not forecasting that any of these events will occur or not occur. I mean, that's betting. We're making decisions recognizing that we don't know the way the world's going to turn out, and we want a really robust and resilient portfolio no matter what. Christian?
Yeah, so two thoughts on that. The first one is, if you remember the matrix that we showed you earlier, often we get the question, well, how do you deal with macro events? And I would say, well, macro events in theory, right, a theoretical event isn't often that much of a determinant. But where macro events can hit one of our companies, that's where it would impact directly the ranking on the matrix, be it on the risk side. Remember, that was on the quality vertical axis, or on the return potential axis with all the points that Paul mentioned here, the discount cash flow rate, the growth rates, and so on. So I would say primarily a lot of macro is taken into account just through the matrix. So automatically, even before we come to risk management and all that, really on a company by company basis. And then the other one, because Paul, as I would like to say, as a new Canadian, like Paul put the puck in front of the empty net, so I will take it from here. So yeah, we have a podcast on that website I mentioned before, The Art of Boring. You can find it through the Mawer.com website, on vulnerabilities versus triggers. We think that the future is always uncertain, and many people spend their time trying to predict triggers. What could go wrong, right? And our view is like, yeah, triggers are usually unpredictable, and the world has a crazy way to do what no one expects. So in our opinion, it is probably more fruitful to look at vulnerabilities. Now that sounds all theoretical. Let me give you an example. Imagine we wanted to go camping in a forest. And we could either go to a dry forest or to a forest that's nice and wet. So the dry forest obviously has a fire risk. That will be the vulnerability. It's a dry forest. Now we could deal with that and say, like, no, we can predict where a fire starts, because we have people looking for campfires for along the rail lines. If there's a spark, people watching for lightning. And our view is that's probably too difficult. It's not in our opinion, not an intellectually very humble approach. So we would rather choose the wet forest, where just the vulnerability of a forest fire is a lot lower than trying to exactly predict where a spark flies and that dry forest catches fire. As humans, we're just more conditioned to watch out for triggers. The newspaper is full of triggers, and then people will say like, oh, it was impossible to predict the trigger. But often in a situation when something goes wrong, actually, if you reflect on it, you'll see the vulnerability. That was easier to predict. Like companies that have weak balance sheets, right? Often you will hear, oh, that company then failed because there was a recession or something. Yeah, but what was easier to see is that they had too much debt in the first place. So our very humble pedestrian approach is we will think about the vulnerabilities a lot instead of trying to predict how the world will unfold, which we don't think is possible for humans.
Thanks, Christian. Maybe just closing this off, like a portfolio example, you're coming back to diversification and sharp edges, and just imagine we're concerned about China. Let's take an example about a geopolitical event with China, maybe Taiwan, where there's a breakdown. And what's important to know is our exposure and our, when we really look through the portfolio, understanding that it's not just a company that's listed with their headquarters. We'll have a business like BMW, as an example, that has, some of their profits, a good share of their profits, that come from China. So that rolls up to, Christian's decision in terms of how much exposure do we want, knowing that there's that possibility. And that's what, we think about when we're building out resilient portfolios.
And that portfolio construction, that all rests on the process that Jeff Moe described, because to understand on the BMW example that a very decent percentage of their profits is from China, well, you need to do all the work that Jeff Moe mentioned. Only then you can say something intelligent about the real risk exposure you have with that investment, which you may not see when you look on paper. Oh, it's a company that's based in Germany, right? So we think it is important to go down and look at the details to be able to make more reasonable risk assessments.
Thank you both for that. And kind of on that risk assessment line of thinking, we did have a question that's specific to the emerging market space. So what are some of the main differences in evaluating opportunities in the EM space versus larger cap equities in North America? Maybe Paul or Christian, you want to take this one?
You start, I'll follow.
Well, it depends on the emerging. It depends on the country, because what you can have is more influence from government. You can have wider distributions. Macro and policy can impact micro. You can have real impact in terms of currency that specifically impacts the company. So, for example, in a lot of places like Brazil, as an example, the debt markets of emerging market countries aren't as fully developed, and so they can't necessarily hedge off and raise debt in the local currency, and it becomes especially more difficult the smaller the company, and so you can get mismatches. We've had situations before where you're looking or examining a company and you're recognizing that revenues and profits are in the local currency, but debt is in US dollars. That's just a structural feature of things that could happen, or what can happen in emerging markets. And of course, that presents a vulnerability should your currency move the wrong way. So there's nuances like that you have to go into the analysis. And of course, you have to compare those risks versus the return potential and stack it up on the matrix.
And that brings us back, I think, to some first principles. You mentioned the emerging market strategy, and before we've spoken about global equity strategy and other strategies more, but we follow one philosophy and one process. So that answer how the emerging market team looks at it isn't different from how other teams look at that process, trying to find out as much about the companies as we think is reasonable, and then putting them on the matrix. My view is often emerging market companies, they are a bit riskier in some aspects. So if I look at them, sometimes I find, that's what weighs on them. But we can own emerging market securities if on the return potential axis, they are more attractive. So that whole thought process follows the first principles we've described in the beginning of today's call.
Thanks. We did get a question about the investment philosophy. So I know all of you love to talk about this, but it's been around for a long time. It's obviously evolved over time and improved. And the question is really, if the 3 steps have stayed the same, what's improved or what's changed as time has gone on?
Well, the philosophy, I would say, hasn't changed. As the presentation said, it's common sense. What has changed, and what we, in my opinion, need to look at to improve all the time, is the process. So how we fill the philosophy with life. the steps that Jeff Moe talked about. I mean, if we had had this conversation 15 years ago, there were some steps that we see as standard today that we didn't do 15 years ago in a standardized way. Forensic accounting is an example. That was not 15 years ago, that was not a standard feature of our due diligence. Some people may have done it when they looked at a company and felt it was appropriate, but this idea that no, we measure now if the analysts have done their forensic accounting, that came sometime over the last 10 years, Paul, right? Like more closer to the 10-year mark than to the 1-year mark.
That's right.
Probably around 2015, 16. So that's where it needs to evolve. The process needs to evolve. We need to get better. The philosophy, I think, in itself is first principles, and yeah, I think it's unlikely that there's going to be change to the philosophy.
Thanks, Christian. Paul, question for you, and Jeff touched on this briefly in the presentation, but clients have also asked about whether our ESG approach or environmental, social, and governance approach precludes any specific investments or industries, or how we actually incorporate ESG considerations into our analysis.
Sure. So we don't exclude any company from looking at it because of an ESG consideration. And maybe it helps to, but there is an ESG philosophy or principles that we use. So the first thing to understand is our primary objective is to produce strong risk-adjusted returns for our clients. Okay, so it's risk-adjusted returns first. Now, we very much recognize as a second principle that these ESG risks can be real and material. And so far as they're material for long-term investors, we incorporate that in all the process work that we do. And the risks quantitatively show up in the discounted cash flow models where appropriate. The third principle is that our approach is integrated amongst our analysts. So if Jeff Moe is looking at a security, he's doing the work on the security, he's looking at ESG risks, he's engaging with management, he's having that conversation, and he'll follow up and vote the proxies based on the motions at the board level. It's a fully end-to-end integrated approach. And I think that's very powerful when we think about change management and improving things, because Jeff or whoever's on the file is empowered to do that. Engagement, Jeff mentioned before, we conduct as a firm over 1,000 management interviews a year with senior executives. So that's an excellent platform to actually engage with them and suggest, hey, we've noticed this about a particular ESG risk. Give us more information, or have you thought about doing this? And what's really cool is that we've developed some IT to support those engagement requests. And this is a shout out to Darren Tan, who's on our technology team and sits in research. And he came up with a really brilliant idea. He said, why don't we, when we engage with a company, open up the equivalent of an IT ticket? And when you have one conversation, maybe you want some information or suggest that, say, the incentives have to change, and you have a conversation. And then there's another conversation, maybe there's some communication going back and forth, there's another comment, and that might stay open for a period of time. And finally, it might get resolved. And just like an IT ticket that ends up getting closed up because the issue is resolved, then that engagement is closed. So we run that back in the background within IT and track all those things. Now, the last one, I think, or our last principle is really important. And this isn't just about how we think about investing with the companies, but it's about what we can do as an organization. And that is, we have to lead by examples ourselves. I think that's a really important leadership principle. I think, the work that we've done on diversity, equity, inclusion has been outstanding. One of the initiatives we're running now is, with respect to climate change, and saying, okay, well, let's explore measuring our own carbon footprint as an organization before going out and telling other people or other organizations what they should do. Let's get our own house in order first. So that's the fifth principle that we have that I think maybe differentiates our approach. So that, hopefully all of this rolls up to strong risk-adjusted returns. That's why we're doing it. But that's the whole package and feature of ESG for our organization.
Thank you, Paul. We've left Krista alone for a little while here, but there's a question that came in on asset mix. And so just how do you decide whether to emphasize small caps versus mid caps versus large caps, or a particular geography in a portfolio?
Yeah, I mean, I can. I'll start this off. I'll maybe leave it open for Christian as well to chime in there. So I think it's Greg and Stephen are the portfolio managers on the asset mix side. And I think what they're doing is looking. We all bring our insights in terms of what's happening. I bring a lot of the macro backdrop, what's happening with fixed income, what's happening with bonds. And then there is a discussion, Christian would bring a lot of the insights with respect to what's happening on the equity side and in different geographies. So maybe I'll throw it over to him to talk about that.
Yeah, I think the important thing is the cognitive diversity and the leader decides with the input model that we have everywhere more really. So Krista, I and Jim Hall, our president and manager of the EFI large cap strategy, we meet with Greg and Stephen regularly, and we tell them what we see in bond land, in equity land, in risk land, and they, based on that input, can make their assessments. And we would look at fundamentals, at current environment, at the fundamental characteristics of the portfolios in question.
Thank you both. Another question that came in, this one would probably be for Jeff, just wondering if you could share your outlook for the Canadian economy and Canadian consumer as mortgages start rolling over at these higher interest rates, and sort of what's our view and of the risks, and specifically they asked about the banks, the Canadian banks.
Yeah, happy to start, Janelle, and Krista might chime in as well. I know she has lots of analysis on those companies. I think we might own some securities that are issued by the Canadian banks. But I would say the Canadian consumer went into the rate hike cycle in a pretty good position. There was high savings rates because of probably underspending as well as government stimulus through the COVID-19 pandemic era. And we came in with pretty strong consumer spending. The Achilles heel, though, for the Canadian consumer was just a really high mortgage balance. So if you go back to 2008, if you recall, that crisis was caused by US households essentially having too much mortgage debt. And at that time, Canada had, Canadian consumers on a per capita basis had far lower mortgage debt than their US counterparts. Heading into kind of this current rate hike cycle, that kind of had flipped, where the Canadian consumer was a lot more vulnerable than the US consumer, which is probably also why you've seen Canada hike a little bit less aggressively than our counterparts to the South. So kind of looking forward, I'd say the Canadian consumer is a little bit more challenged. And when we look at some of the companies we own in the Canadian small cap portfolio, they are showing kind of signs of rolling over a little bit in terms of their earnings growth. And then specifically on the banks, they are having a more challenged time just because a big part of their loan portfolio is mortgages. And mortgage growth and new originations, new people wanting to buy new properties is starting to slow. And so earnings growth probably does moderate there, as well as some of their unsecured lending as well. But overall, Canadian banks operate in a very strong oligopolistic market. They have very strong return on equities. So our 5 to 10 year view is still very constructive on those holdings, which is why we are overweight banks in our Canadian equity fund versus the index. But Chris, I don't know if you have anything to add there.
No, I mean, I think you covered a lot of it. The one thing I would add with respect to Canadian banks is they are starting at fairly elevated capital levels. And they've been continuing to add to that over the last few years, I guess. We do own Canadian banks. I think one of the things we're watching pretty closely is things like non-performing loans, and we actually haven't seen those start to tick up at all, which really comes back to Jeff's comment that the Canadian consumer did start off this sort of rate hiking cycle in a better than expected place. I will say, if the central bank continues to hike, if inflation stays elevated, when a lot of these mortgages renew in sort of 2025, 2026, you could see the risk start increasing then. But we're fairly mindful of that and kind of watching for any vulnerabilities that we kind of see arise.
And certainly, at least on the equity side, I think valuations have adjusted for that possibility already.
Thanks, Jeff and Krista. Well, given our head office is based in Calgary, there's often questions to do with the energy sector. So this next one is kind of about sustainable or renewable energies. And I think building on that, just given where oil prices are at now, has our view on the sector or industry changed at all? Historically, we've been relatively underweight in energy versus the S&P TSX. So maybe, Jeff, if you wouldn't mind just talking about our view on that sector and maybe the opportunities or challenges in that space.
And sorry, Janelle, just to clarify, was that question on our views on the renewable energies industry or on the traditional oil and gas energy industry?
I guess both. Yeah.
Fair enough.
Yeah.
Yeah. So maybe I'll start with traditional oil and gas first. So as we probably know, oil prices are higher since certainly the bottom of the pandemic when WTI futures contracts briefly traded negative. But I would say if I look back 5 or 7 years, our view on long-term oil prices hasn't materially changed on a fundamental basis, so on a supply-demand basis. But the reality is with oil and gas or hydrocarbon energies, geopolitics has always played a large role in setting prices. So the recent geopolitical setup, call it the last 1 or 2 years, as well as, frankly, the fundamental supply-demand setup, just underinvestment through the COVID years, has made us more incrementally positive on oil investments in the last couple of years. And you can see that in our Canadian equity fund. While the fund is still overall underweight compared to the index on energy, for oil producers specifically, we are about equal to the index today, as we think that's the most attractive part of the oil and gas hydrocarbon energy value chain. And similarly, in the New Canada Fund, you will have also seen us increase our position in upstream oil and gas production. On the renewable side, it's actually right now a sector that's going through a bit of a recession or a bit of a downturn. Although that's probably temporarily, given that the U.S. stimulus with the Inflation Reduction Act is starting to flow through and come through. But generally, I think the long-term trend of kind of 2050 kind of net zero carbon emissions and this kind of push by most of the world to decarbonize our economy will allow renewable energies to continue to have a secular tailwind of growth. The issue for us with our investment philosophy is to find companies that actually have a strong, durable competitive advantage. Many of these companies are producing things like windmills or solar panels. These are all commoditized products. And while you can build a lot of them, it's very hard to make a little profit on them. And so currently, when I look through the portfolio, the areas that we've maybe found more ways to win is, call it in the picks and shovels, to use a gold rush analogy. And so one company might be a company like Amphenol, which is one of the world's largest producers of electronic interconnectors. And what an interconnect is when you need two pieces of electronic instruments to talk to one another, you need an interconnection point. And so they make literally millions of different types of interconnects, of which a chunk goes into renewable energy products. So I think those are the areas where we found more opportunities. But certainly renewable energy is an area we continue to look for because we definitely see the secular theme that the rest of the world sees.
Thanks, Jeff. And unfortunately, it looks like we're already at our time for today. Time flies. when you're having fun. Thank you to all our panelists today and everybody online that joined and submitted questions. If we were unable to address your specific question today, please do feel free to reach out to your Mawer advisor or to email the events@mawer.com address for additional information. The recording of today's session will be up on YouTube likely by tomorrow, so you can share it, and you will receive a survey shortly after this session to provide your feedback. So thank you to everybody for joining us today, and I hope you have a great afternoon.